How can you accidentally earn $25,000? Let me tell you the story of how my friend made this money just by googling a news article. So my friend Alex couldn't sell his car for 3 months, not a single call, and suddenly a few days ago his phone started blowing up with questions. Can I come take a look? Is the price still valid? Why is it so cheap? So for 3 months he got 0 calls, and now suddenly it's too cheap for them. Alex didn't understand what had changed, so he decided to Google what had happened in the car market. It turned out that since October the 1st, the government had doubled the recycling fee. So the price of any new car used to have an additional $2,000 added, but now it's $5,000. People in a panic started buying cars before the prices went up. Alex thought, well, if it's cheap for them, I can sell it for a higher price. And in the end, he sold it for $25,000 more because such greedy purchases increased costs of whole car market. My friend, not knowing about this, accidentally made money through trading. There are 3 things people think about trading. First, it's somehow related to money and a bunch of confusing terms. Second, it's some kind of a scam and info salesmanship. Third, it's this meme. And it's clear why there is such an atmosphere around trading. In trading, you can indeed make a lot of money in one go. And different influencers want you to believe that such earnings happen every day. But trading works on the principle that if you know more than others, if you react faster, then you will be much wealthier than everyone else. And my friend Alex could have made that money too if he had known about new tax in advance. For example, what I did when COVID started. As soon as they started talking about possible restrictions, I thought, what difficulties will people face? What will they need more than usual? Pause and write, how would you answer? And I bought shares of Zoom and Netflix. Companies will need Zoom to continue working, and Netflix will replace entertainment outside the home. Well, I raised from 10K to 83K. Purely because I thought for 3 seconds. How could you have earned much more in such a situation? Most people only found out about the new tax after it had already been introduced. My friend could have borrowed money from someone in advance and bought up as many cars as possible before people started buying up everything in a panic. And when the panic started, he could have sold these cars for more than he bought them for. So it's a risky move to invest such a large sum in buying cars. What if he can't sell them or the deal falls through? But car dealers don't think like that. Not only do they closely follow the news about cars, but they also know exactly how people behave in such situations. So why didn't everyone become a reseller then? And why didn't a reseller become synonymous with a millionaire? People really rush to buy goods when they don't know what an event will lead to. There are even terms for this phenomenon: expectation effect and panic buying. When the USSR began to collapse, people arrogantly bought items that had value on their own, like cars, because they didn't know how much the currency would be worth in a few months. Or when COVID started, I remember people buying toilet paper by the ton. In this sense, resellers are right. But they could be wrong about the fact that the prices will skyrocket due to the new fee. But how is that even possible if the fee literally states that all new cars will now cost 25K more? Raising the fee doesn't necessarily have to lead to higher prices for cars. For example, car dealers may start to fight for buyers and will not raise prices for cars. Or people will stop buying cars after their price increases due to the fee. And over time, car dealers will lower the price to the previous one so that at least someone will buy a car. And in theory, car prices may even fall. For example, this is what happened in 2024 in the electric car market. It was expected that after COVID, the prices for materials for electric cars would skyrocket. But the opposite happened. Prices fell because Elon Iron Man Musk built a couple of battery factories, reducing the chain of intermediaries for creating cars. And in the end, we would go into the minus from our large loan because we bought cars at one price and after a while they became cheaper. In short, we would have made a fool of ourselves. Anything can happen and no one can predict this. And there is even a term for it. When 2 or more parties participate in any process and fight for their interests, it is called a game. And there is game theory. One of the types of games are called symmetrical and asymmetrical. Symmetrical games are when all players know all the information and all the rules and they do not change. For example, chess. One player cannot take a piece in the middle of the game and say that now it is a combat helicopter. But in trading it can, because it's an asymmetric game. But is there really no way to regularly earn money from trading? After all, instead of a car, it could be anything, whatever you are interested in. Just imagine if you figure out, thanks to the news, that the price of some product would skyrocket and you were right. You could make a fortune from it. Of course, it's possible. Otherwise, what would all those people with 5 monitors be doing? And for this, we will need an exchange. But now it looks like this. We want to repeat the car story, but now on purpose. We want to predict the price change of something in advance and make money from it. So where do we start? First, we need to go to an exchange. An exchange is a website where all buying and selling happens. Here, we will buy our car and also sell it once its price increases. But let's ditch the car idea. Let's imagine you're into collecting Pokemon cards. You know how much different set costs and you generally follow the news about cards. One evening, while sitting on your bed, you stumble upon a news article that says Pokemon cards production is moving from China to Switzerland. We've decided that this will cause card prices to skyrocket because labor in Switzerland is much more expensive. Now, we need to quickly buy as many boxes of cards as possible on the exchanges before the prices go up. So you go ahead and buy them. Here's the thing though, you're not buying the cards themselves. The point is, they won't be delivered to your door in 2 days from Amazon. You are buying the fact of owning them. All the boxes of cards are stored in a hypothetical warehouse. Each box has a tag on it indicating who owns it, and that ownership is constantly changing. But why do this? For 3 seconds, let's forget about the cards. Let's assume you bought something big and expensive. For example, you bought 15 tons of coal because you think it's going to get more expensive soon. You bought the fact that these 15 tons are yours. At the same time, you get a contract stating that these 15 tons will be delivered to you at a later time, and the delivery date is written in the contract. But do you actually need 15 tons of coal? You wanted to make money on the price difference, right? The same goes for all trades. They don't need 15 tons of coal or cars or even cards. That's why they close their contract for ownership of a product before the delivery date and pocket the profit. When you buy something that already exists, it's called spot. You can theoretically touch it when it's delivered, but you don't really need to. Here's another interesting example. You buy 10 tons of grain on the exchange. You bought the spot, waited, closed the deal, and took the profit. Now, imagine a farmer who has already sold all his grain, but he needs the money now, so he sells the grain that will only be harvested in a year. That is, it doesn't exist yet, but he's already selling it. Yes, you can do that. But suddenly a fire started in all the countries that produce grain. Half of the grain in the market is burning, and you were the first to know about it. You are standing right next to the field with your laptop, and maybe you even started the fire. The fire means that next year the harvest will be much smaller and they will pay more for wheat. But until everyone knows about the fire, you start buying up contracts for grain that doesn't exist at the old price. It only matters in what period of time you concluded this contract. Such a contract for a product that will appear in the future is called a futures. But more and more people are starting to find out about the fire through the news. And that means that more and more people are starting to organically buy grain like us. This leads to the price going up, because the demand for wheat, what is still cheap, is increasing. But have you ever wondered why exactly the price goes up due to high demand? To understand this, we need to learn how anything is actually bought or sold on an exchange. There are 2 ways to buy or sell something. Let's say you want to sell a ton of wheat. The average price right now is $50 per ton, but you don't want to sell it for $50. You want to be greedy. You want to sell it for $70. So you place your wheat for sale at $70 and wait for someone to buy. This is called a limit order. That is, you put something on display and said someone will buy it and I will wait. The same goes for buying. You place an order to buy a ton of wheat at a price lower than the market price, $30, and wait for someone to sell it to you. It's like a beggar with open hands. But let's say we urgently need to buy something, in our case, grain, in an emergency. So this is called a market order. That means we buy instantly at the lowest available prices. In this case, we specify the amount of the grain we want to buy. For example, we want to buy 100 tons. How and from whom can we buy the grain? Only from those who have listed their grain for sale. So only from limit orders. Right now, the market price per ton is, it's $50. So we buy the 50 tons that are being sold at the market price. And now we have run out of sellers at the market price. The only ones left are those selling at a higher price. Remember the phrase, someone will buy it, I will wait. Well, now we, the buyers, are those someone. Now the cheapest price for wheat is from those selling at a higher price. Now their price is the average. This is exactly why the price increases on the exchange due to high demand. Okay, we've learned one method of making money from trading. We buy something at one price, then set fire to half the world's wheat, analyze what's happening in the world, make a prediction about when our asset will rise in value, wait, and then sell. This is called a long. But that was just one way to make money in trading. What if you missed that a certain product is about to go up in price? You can make money the opposite way when something decreases in price. That means you need to find something that you are absolutely sure will drop in value soon. There was one such situation. At the beginning of 2021, when COVID hit, many traders started paying attention to a store chain selling video game discs called GameStop. People almost stopped buying games because of their online versions. On top of that, COVID restrictions made it so no one could go out unnecessarily. If you were looking for something that's about to suddenly become unnecessary, would you have paid attention to GameStop? Well, that's exactly what the traders thought. They started borrowing GameStop shares, not buying them, but borrowing them from the store itself. GameStop would lend them out for free, with the condition that they be returned after a certain period. Why would anyone do this? As soon as the trader borrowed the shares from the store, he immediately sold them at market price. For example, $10 per share. He had 20 shares, so in total, he got $200. It's like if a friend asks you for your iPhone, promising to return it in a good condition, and then sold it right away. Now, the trader has to return the 20 shares to the store in a month. However, over the month, COVID restrictions increased. The store lost its last customers, so its value dropped. Now, the shares were worth not $10, but $5. We're sitting back and enjoying our $200, but we still need to give back the 20 GameStop shares. We buy the shares back for half the price. We spend $100 to return them, and the remaining $100 is our profit. The strategy is called short. Now that we know 2 ways to make money on the stock market, how do we get serious about it and start earning big? Basically, you need to do what we mentioned in the video. Keep an eye on the world around you, understand how people behave, and most importantly, react quickly, just like in the examples with wheat or GameStop. But if you think that's all it takes and you start acting on it, you will lose all your money in no time. Let's go back to GameStop. We weren't the only ones who smartly decided to short stocks of a dying company. What do you think happens when a lot of people decide to short the stock at the same time? The events that occurred were so significant that they were made into a film. Dump money. We shorted assets hoping they would sink to zero, but instead, they started rising. To avoid losing more than we're willing to, traders set a price where the asset automatically sells. The price is called a stop loss. It also works when you're betting on the price dropping. So we have certain price levels where a bunch of people will automatically either sell or buy assets. And at one point, a large group of Reddit traders noticed that the GameStop stocks were being shorted and then immediately bought. This group decided to mess with the big traders. The Reddit crowd bought up the majority of GameStop shares at once. And here's what happened next. This group bought the stocks at an incredibly low price. Then they started buying up the more expensive ones. They kept doing this until this price shot up to the sky, and at that point they couldn't sell their shares fast enough. But here's the thing, people had stop losses in place. They initially limited how much they could lose. However, they were also those who didn't set stop losses. But here is the catch. Buying and selling don't happen just like that. As I explained earlier, in order to buy something, someone has to sell it. And the people who owned the stocks understandably didn't want to sell them because the price was rising sharply. And those who had borrowed the stocks now urgently needed to return them to the store, so they had to buy them back. But no one was selling. So they had to pay hundreds of times more just to get someone to sell them the stocks. It's like when you're selling something on Amazon. You've been waiting for 3 months to sell your bike and you get tired of waiting, so you drop the price and boom, it sells immediately. But here, it was the opposite. Imagine someone pointing a gun at your head, demanding you give them the bike right now. And so you start throwing money at people just to get them to sell your bike. This story shows that the stock market and trading are very complex and at times dangerous places. There are an insane number of variables. On top of that, you need to study the fundamentals of how the economy actually works. It turns out that companies can borrow things and then pay them back. You can get fabulously rich, but you can also lose it all just as dramatically. Trading is as much a science and craft as programming or painting. The so-called fantastic profits in trading are just an easy way to sell you a dream. Don't fall for it and subscribe to the channel if you want to learn more about everything related to money. See you guys, don't forget to share this video, like, subscribe to this channel, and don't forget this channel. Michael was with you, bye!